And welcome to ETF Edge, your go-to place for everything exchange-traded funds. I'm your host, Bob Pisani. Legendary investor Jeremy Grantham is getting into the ETF business. His firm, GMO, is launching its first ETF, the GMO U.S. Quality ETF. The symbol is QLTY this Wednesday. Let's talk with the manager of that fund, Tom Hancock. Also joining us, Nate Geraci is the president of the ETF store. Tom, Jeremy Grantham, 45 years ago must have founded GMO. Why get into the ETF business now, and why quality? GMO is famous for value investing, so why quality?
Yeah, well, it's really coming from our clients. A lot of them are really excited about investing in ETFs. Of course, there are the tax advantages, but even amongst our institutional clients, just the ease of trading them is pretty material. And then the other thing is that active strategies, we manage an active portfolio. There's a lot more interest in active ETFs than there was even a few years ago.
Yeah, that makes sense to me. Now, you already run a quality mutual fund, GMO Quality Mutual Fund. The symbol is GQETX, those of you who are writing this down. How is this different? Is it the fund is, I understand, slightly, the mutual fund is slightly different than the ETF you're going to be running. And while you're doing this, define quality for us so we all understand we're talking about the same thing.
Yeah, so similar style investment philosophy team. The difference with the ETF is it's only invested in U.S. stocks, whereas the mutual fund has about 20% in non-U.S. multinationals. Now, what does quality mean for us? Quality is about companies that can sustainably deploy capital at high rates of return. They can do things competitors can't, moats around their business. They have strong balance sheets. These are battleship companies that are going to remain relevant and important going forward.
Now, we're putting up the GQETX. This is the mutual fund that you're managing. I assume that your biggest holdings in the ETF will be similar here. You see Microsoft, United Health, Johnson & Johnson. These are names familiar to all of us. This shows up on quality screens all the time. You also get Apple and Alphabet and Amazon. It's really a big cap fund with a slight tilt towards technology, I guess, at this point, right?
Yeah, that's right. And there are really three sectors where we've traditionally found attractive opportunities. It's technology, it's also healthcare, and then a lot of the consumer staples, the branded consumer companies that have been around for so long.
Yeah, the Johnson & Johnsons of the world. That always shows up on a quality ETF screen. Nate, this is a pretty saturated ETF market. There's an awful lot of quality ETFs out there. More than a dozen, at least. Can somebody like a GMO really stand out in this kind of market?
I do think so. You know, I love the fact that more traditional active managers are getting involved in ETFs because that offers choice for investors. And really, it's a natural evolution of the ETF wrapper, which over the years, that wrapper has proven to be lower cost and more tax efficient. And if you think of an active manager attempting to generate after-tax alpha, the ETF wrapper helps lower that hurdle. It offers a better chance at outperformance. But bigger picture, I think it's interesting because the ETF industry was built on the back of passive management, but the industry has evolved. And quite simply, asset managers are meeting investors where investors want to be met, and that's in the ETF wrapper. I was actually looking at flow data the other day. Over the past 10 years, there's been about $4.3 trillion that has gone into ETFs. Well, $2.2 trillion has come out of mutual funds, much of that on the equity mutual fund side. That's a $6.5 trillion swing, and I think that's obviously tough for any asset manager to ignore. So I think active managers coming into the space, offering their best strategies in an ETF wrapper, I think is their best chance at success longer term.
Yeah, that makes complete sense to me. I mean, we've seen notable inflows this year in a year, Nate, when there's been sort of underwhelming inflows in stocks and bonds. We've seen notable inflows into actively managed. I want to ask you about value because Jeremy Grantham has always been associated with value. Value's underperformed growth for years. I think, except for 2022, S&P growth has outperformed S&P value over 20 years, 10 years, 5 years, and even year to date. It's underperformed. Value's underperformed. In theory, I'm a Jack Bogle guy. He believed in reversion to mean. This makes some sense to me. I think so. And yet it's not really happening in any big way. Can you describe why this is happening? What accounts for this long-term outperformance of growth over value, and is that going to continue?
Yeah, and we are value investors at GMO, but to us, value doesn't mean just a low price index. There's a lot of low quality cyclical businesses that can't really differentiate and are kind of going nowhere over time. We like to talk about intrinsic value, which is companies that can grow and grow at a high return on capital and that can be reasonably priced. And that kind of company has been doing very well. And I think that kind of trend can continue as long as there's innovation and growth opportunities going forward.
Yeah, and yet, Nate, year to date, as I said, growth is outperforming value. Not only that, but the flows are going the same way. Growth ETFs, I think you gave me this, $16 billion in inflows. Value ETFs, $6 billion in outflows. So we had that one good year in 2022, but we're back to the trend of growth over value, and the investor seems to smell that again.
It's amazing. I mean, there's been a massive performance spread this year between growth and value. I show over a 30% differential in performance if you compare, say, the iShares Russell 1000 Growth ETF to the Russell 1000 Value ETF. If you think about this, that's a really tough pill to swallow for value investors after, to your point, it appeared value was turning the corner in 2022 following years of underperformance. You look last year, value outperformed growth by 21, 22%. So I think coming into 2023, a lot of investors expected that to continue. It's been the exact opposite.
Yeah, and yet everything has a price, right, Tom? I mean, if value is not cheap enough, it eventually will get cheap and somebody should buy it. In theory, if you believe in reversion to the mean, I know value guys, we debate about China all the time. There are value guys who don't care about the political debates in China. They'll buy if it's 14 times forward earnings or less on a certain index in China and don't care about anything else. Why isn't value get cheap enough for it all of a sudden to outperform? I mean, even crummy stocks, you know, that don't have much earnings growth do have a price. Everything's got a price where somebody will buy it.
Yeah, but I think if you look at those crummy stocks in the market today, they're not particularly cheap by historical standards. Really, the action is in growth. Value's gone nowhere. And we've seen a lot of interesting things going, obviously AI and stuff going on this year. There is a lot of innovation. And from a point of view of a value investor, while some of the most well-known stocks, maybe at kind of frothy valuations, there's a pretty big supply chain, pretty big ecosystem there. So there's a lot of growth at a reasonable price, high-quality opportunities to invest.
So is it that value has, it's not value has dramatically underperformed, it's growth has dramatically outperformed?
I think that's the way to think about it.
A certain way to look at it. I mean, when you get top 10 stocks up and 30% on average, that's pretty remarkable overall.
Yeah, this is an unusual environment where there are so many opportunities for large cap equities. You don't normally see that.
Nate, does this whole game of growth versus value make a lot of difference anymore? This is one of the longest old school debates I've ever had, growth versus value, in terms of a factor debate. Maybe it's just obsolete these days. Maybe we should just stop debating this whole game, and some stocks are, growth prospects and others aren't, and just forget about it. I've been doing this for 30 years, and after a while, I just want to say, well, it's time for everybody to move on.
Well, you're right. It's always a compelling argument to just own the S&P 500 and not attempt to split into factors. But, to what Tom was saying, if you look, a lot of gross performance this year has been driven by the so-called Magnificent Seven, because if you look at many of the growth indices, they're pretty top heavy. And so the largest growth companies have been enough to really drive that performance differential versus value. And I would say, even if you look a layer deeper than that, obviously the artificial intelligence mania we saw earlier this year, that's been a big driver of mega cap tech stocks. And then I think you have investors just anticipating or assuming the Fed will cut rates at some point, which theoretically would help growth. But to what you're saying, do you want to attempt to play all of that or just own the S&P 500? The other thing is value tends to be pretty heavy financials and energy. You look at the performance of both of those sectors this year, it's been very underwhelming. Yeah,
dramatically. And here we have another example of an actively managed ETF. So I know you mentioned before the industry's on pace, Nate, for a record number of new launches, but they seem to be primarily active ETFs. So what does that tell us now about the state of active? I mean, what it tells me is it seems like we sort of exhausted the possibility for growth or new funds in the index space. Active has sort of become popular because of the exhaustion of the possibilities of indexes, and the success of that space is pulling money away from mutual funds. So if you're an active mutual fund manager, you have to consider some kind of ETF at this point, it seems to me.
Yeah, I 100% agree with that. I mean, the fact of the matter is, all of the passive strategies are spoken for, right? Somebody isn't coming to market with a new S&P 500 ETF or Russell 2000 ETF. You're not going to compete there. And even if you look at the smart beta or factor ETF space, there's just not a ton of room for new products. But with active management, you can differentiate, assuming the active manager is actually doing something meaningfully different than the underlying benchmark. But that ability to differentiate, I think, is the key driver here, because it's a way to stand out in a highly competitive industry. Yeah. And what you were saying, you look at launches this year. So we've had about 450 new ETFs come to market. That actually puts the industry on pace to eclipse 2021's record of around 475 ETFs. And when you look at the composition of those launches, I show about 75% are actively managed. And it's all stripes of strategies from some of the largest names in active management. Obviously, GMO, you look at Capital Group, Fidelity, Calamos, Franklin Templeton, T. Rowe Price, Dimensional, JP Morgan. We could go on and on. It's truly the biggest brands in asset management continuing to leverage the ETF wrapper.
Yeah, it's quite remarkable. I like to always say and joke, Nate and I know this joke, that a mediocre active manager in a mutual fund wrapper is going to be a mediocre active manager in an ETF wrapper. You just have lower costs overall. How has your actively managed mutual fund, the quality fund, fared against, say, the S&P 500?
We've done quite well. We've added value against the S&P since inception, which is 2004. And I think what our clients value as much as that is that we've been universally protected capital in a relative sense in the down market. So, of course, the financial crisis, but also last year, we managed a quality strategy that outperforms the down market in part because of its valuation focus historically, but also can participate in growth in a year like this.
How are you doing this year, your performance?
We're outperforming in our mutual fund by about 5 percentage points versus the S&P year to date.
That's fine. Now, let me just ask you about asset bubbles, because Grantham famously has called a number of asset bubbles in the past. The Japanese asset price bubble in 1980, the dot-com bubble in 2000, and the housing bubble in the mid-2000s. Does GMO see any asset bubbles that are out there right now?
At the broad asset class level, no. There are always little dislocations, but our asset allocation group, as we call it, does actually see a lot more opportunities there than GMO, which I know we do have a reputation as being bearish, but we're seeing opportunities out there.
Jeremy has, yes, that is generally the perception of him, although he's been very successful. His perception is generally he's bearish. Now, he's famous for value investing and for making bets when asset prices deviate from their historic norms. That's sort of been the mantra here. So where are we? I mean, can you tell us generically, do you think asset pricing, is the stock market cheap or expensive right now overall?
Yeah, well, Jeremy would tell you the stock market's expensive. And I would say maybe that's true about the stock market, but there are a lot of opportunities out there. And that's why I think active management is particularly important right now. It's maybe a dangerous time to buy the whole index.
A dangerous time to buy the index?
The whole index, yeah.
And why is it dangerous now?
Well, I think valuations are stretched. Of course, there's a lot of uncertainty. We care a lot more about long-term things like geopolitical than just the economic cycle. But
valuations are stretched now, and the S&P is up 15%. I mean, if Jack Bogle was sitting here, he'd say, okay, so the valuations are stretched, but we're still up 15%.
Yeah, well, we're a long-only equity shop. So, again, there's a lot of great opportunity there. And we talked about AI, GLP-1 drugs. There's a lot of reasons to be excited about investing in corporate America. So
let's talk about 2024. I mean, this has been a very choppy year for investors. Generally, mega-cap tech stocks have dominated. We all know that. Interest rate-sensitive sectors, REITs, utilities, generally have had a tough time of it recently. And even defensive sectors like healthcare and consumer staples have had a tough time of it recently. A large part of the investing public seems very happy to park all their money in money market funds these days. $6 trillion in money market funds. Do you have any sense, does GMO give any outlook for 2024, say stocks versus bonds, or overall macro view?
Yeah, well, GMO takes a long view, so we're not going to have a view on 2024 particularly. I would say rates were going up. They are up. So I think that damage has been done for a lot of asset classes.
Are they going to go higher?
Well, I wouldn't make that call myself, but I'm not not an expert on that.
Yeah. So you don't have a call for 2024, though, overall?
No, I have a call that there are great stocks to invest in. We want to invest in them, and they're priced in a way that you don't have to wait too long to enjoy the return.
I'm sorry, Nate, do you have any other thoughts other than the big story this year is flows somewhat lower than in the past, overall stocks and bonds, big inflows into any kind of short-term treasury funds, and inflows into active management. That's the sort of 30,000-foot point of view. Any other sub-areas that you think are very interesting that have been going on or that might be big trends in 2024?
Well, a couple of points. First of all, I do want to go back to valuations, and I would agree with Tom that valuations appear stretched right now, but valuations can be very poor short-term timing indicators or much better longer-term tools. And so actually doing something around where valuations are right now, and as we head into 2024, I think you have to be careful as an investor. When I look at ETF flows specifically, flows have been muted this year, but we've still had about 400 billion come into ETF. So it's still been a solid year despite everything going on. I think if I were to look at a specific area, it would be Treasury ETFs, because the bottom line is the fact that you can get a 5% plus risk-free yield is a game changer when you consider everything going on right now, from questions over whether the Fed will be able to orchestrate a soft landing to geopolitical concerns. We have an upcoming election next year, which could contribute to volatility. And so I think some investors are content to simply hide out in treasuries and scoop up that 5% plus yield without worrying. And then I think if you look on the longer end, so that would be on the short end side of the equation. On the longer end, we're seeing flows into ETFs like TLT, the iShares 20-plus year Treasury ETF. I think you have some investors that are attempting to call a top in long-term rates. They want to hedge against a potential economic slowdown, and TLT could be a nice portfolio diversifier. So I think we're going to continue to see flows into fixed income ETFs, particularly Treasury ETFs, because I think some investors don't want to take on that credit risk, looking onto the corporate credit and the high yield side. So that's a trend I expect to continue as we move into 2024.
Yeah. The TLT is the most interesting thing I've seen in a while in terms of movement, because that was such a mess earlier, and to see that turn around a little bit, that's a big story. I want to talk about that a little bit in the ETF Edge podcast. We're going to have to leave it there, though, right now. That does it for this week's ETF Edge. My thanks to Tom and Nate. We've asked Nate to stick around and give us his thoughts on ETF trends. I want to talk about that TLT and where it's going for the rest of the year. The ETF Edge podcast is coming up. And remember, you can see all of our shows on our website, etfedge.cnbc.com. Everybody have a healthy, happy, and safe trading week.
Get the ABCs of ETFs with the ETF Edge newsletter. Your weekly update on the hottest trends, expert analysis, actionable ideas, and exclusive insight from host Bob Pisani. Sign up now at cnbc.com/ETF Edge newsletter.